What does move precious metals prices in my lifetime has been investors and savers' fears of the depreciation of their savings and investment instruments denominated in fiat currencies, but particularly, even on a global basis, denominated in US dollars during periods of time when there have either been negative real interest rates or the threat of negative real interest rates, either as a consequence of low rates or high inflation, or both. Gold has done very well. People often say to me, Rick, when will you sell your gold? Well, when the reasons to own it go away, the gold will go away. Gold isn't a promise to pay. It's payment in and of itself. It has value separate and apart from a medium of exchange, which is important to know. You mentioned trust. If you acquire gold that you are relatively certain is what it purports to be, you don't need to trust the counterparty. It isn't a promise to pay, it's payment. The important thing about gold and silver is that they aren't checks or they aren't fiat currency. They're payment in and of themselves. Right. And in periods of time when there are various forms of turmoil, war would be an example, and social trust is very low, precious metals do very well. My own experience has been that the global perception of geopolitical risk, which is to say war, isn't a long-term impactor on precious metals prices, unless the war impacts you. If you were a Vietnamese person, wanted to leave Vietnam, got off on a boat, gold was worth a lot more to you than Vietnamese currency. Precious metals have moved up in price over the years for many reasons, most of them not good. It has functioned for years as a medium of exchange and a store of value, and that's important to know. Most mediums of exchange that we use are abstractions, floating abstractions. Our mutual friend Doug Casey once said that the dollar is an IOU nothing, and the euro is a who owes you nothing. People need to be afraid of the maintenance of their purchasing power in conventional instruments, and why I think that gold and silver, are much more likely to do well than poorly. That the market share of precious metals is the lowest that it has been in my lifetime. Let's face it, we've lived through 40 years of pretty easy economic times. You, as an apartment building owner, every 5 years get to refinance at a lower interest rate. The capitalized value of your rents relative to your cost of capital is certainly low. Sadly, that's over. We've learned in the last 40 years that we don't have catastrophes, so we don't need to own gold. The consequence of that is that the market share of precious metals and precious metal securities relative to other savings and investment assets in the United States is less than 0.5%. Less than 0.5% of the value of savings and investment assets in the United States is in precious metals or precious metals securities. The 3-decade mean is between 1.5% and 2%. So if demand was to return to mean, not go crazy like it did in the 70s, demand for precious metals returned to mean, demand would triple or quadruple. And there's one more that a lot of people overlook, and that is that after 40 years of really beatific economic conditions, the biggest investors in the world, the pension funds, the endowments, the insurance companies, operate on an asset skew that's roughly 60% equity, 40% debt. And that's worked well for them. The debt has been the stability. The debt has been the stable income. The debt component is a real anchor in a positive sense to the returns that they've promised their beneficiaries 20 or 30 years out. That's all different. If you look at debt markets today, even the junk bond index, where you're taking real credit risk, is yielding 4.7 in a currency where the purchasing power is deteriorating by 6.5. It's almost as though you're guaranteed losses twice, once on the instrument and once on the currency. And I believe that you're going to see fairly massive disintermediation out of bonds and debt instruments by the largest institutional investors in the world, because they have to do it to fulfill their mandate. People need to take control of their financial present and their financial future, because the big thinkers neither will or can. And so the real why around precious metals, I think, is self-defense. All the U.S. dollars in circulation have come into circulation in the last 30 months. Now, clearly, this isn't to accommodate economic growth. The economy isn't 30% bigger. than it was 30 months ago. There wasn't need for liquidity to manage a buoyant economy. And when you increase the supply of something without increasing its utility, of course, you depreciate the value of the existing stock. There's just no arithmetic way around this. So quantitative easing is the first reason, I think, why investors are concerned about the efficacy of their savings in conventional instruments. But it gets worse, of course. The next is debt and deficits. And this is arithmetic again, too. We have the dubious honor of having crossed $30 trillion in on-balance sheet liabilities. Admittedly, only $22 trillion net of counterfeiting. In other words, the Federal Reserve's balance sheet is $8 trillion. That was printed up. So, but let's use the 30 trillion. It's their number. But more importantly, any creditor, and I'm a creditor, who looks at a borrower, the U.S. government, that has debts that they can't service, and they're continuing to refinance them, becomes concerned about their principal. An investor's principal is the savings, the maintenance of the savings in U.S. dollar-denominated securities. But it gets worse. The worst is negative real interest rates. For the first time, government has made a promise to you that they're going to keep, and I'll explain that promise. If you lend the government money in the U.S. 10-year Treasury, the base security in the world, the most important security in the world, they promise to pay you 2%, and they will, because they can print it. They don't have to earn it, they can print it. They promise to pay you 2% in a currency that, depending on which government agency you read, is losing its purchasing power at 6.5% a year or 7.5% a year. So they solemnly swear to reduce your purchasing power by 4% compounded a year for 10 years. And they will keep that promise. If you give them money now, they will give you back less later. They're guaranteeing this, and they will do it. And the whole concept of return-free risk, the whole promise, is the real reason why people might own gold. Because of your fear of inflation, it is logical that some of the money that you take out of one asset class goes into an asset class that has a millennium-long track record for protecting you against the depreciation and deterioration of the purchasing power of fiat instruments.